$18.8 trillion. That is the total amount of household debt in the United States right now. American households are carrying more debt than ever before. This includes mortgages, credit cards, auto loans, and student loans. But the biggest concern is not simply the size of this number. The real issue is that the cost of carrying this debt has increased significantly. For years, Americans benefited from extremely low interest rates. Borrowing money was cheap. Mortgages were more affordable. Loans were easier to manage. But that environment has changed. Interest rates increased sharply, making debt much more expensive. Mortgage payments became significantly higher. Car loans became more expensive. Credit card debt became harder to pay off because of high interest rates. At the same time, everyday costs increased. Housing, insurance, food, and other essential expenses became more expensive. This created a difficult situation for many households. People are not only carrying more debt, they are also paying more to maintain that debt. This pressure is already visible in consumer behavior. When households spend more money on debt payments, they have less money available for other things. That can affect spending on restaurants, travel, entertainment, and large purchases. And because consumer spending is a major part of the U.S. economy, weaker consumers can slow down economic growth. The problem becomes bigger if more people begin falling behind on payments. Higher missed payments can put pressure on banks, lenders, and the wider financial system. Another major issue is housing affordability. Home prices remain high in many areas, while mortgage rates are much higher than they were a few years ago. As a result, many Americans who could previously afford a home are now unable to buy one. This affects more than just buyers and sellers. A weaker housing market impacts construction companies, contractors, real estate businesses, furniture companies, and many other industries connected to housing. This is where comparisons to 2008 appear. The situations are not the same. In 2008, the main problem was that banks gave millions of risky mortgages to people who could not realistically afford them. When those loans failed, the housing market collapsed and triggered a global financial crisis. Today, banks are better regulated, and the problem is not the same type of mortgage crisis. The concern today is whether high household debt, expensive borrowing, and rising living costs could put increasing pressure on consumers. The biggest lesson from 2008 is that financial problems usually do not appear suddenly. They build over time. High debt levels alone do not create a crisis. The danger comes when too many people are unable to handle their payments at the same time. The $18.8 trillion household debt figure does not mean another financial crisis is guaranteed, but it shows that American households are facing a historically high level of financial pressure, and how consumers handle this debt could become one of the most important factors shaping the future of the U.S. economy. If you enjoyed this video, make sure to like and subscribe for more breakdowns of the biggest financial stories happening right now.